Welcome to another installment of the Whitaker-Myers Wealth Managers What We Learned in the Markets This Week video. Remember, our aim is to provide you, our valued clients, with a brief video giving you information that is helpful to your understanding of the markets while also drowning out the agenda of the news media in America. Now, this morning we had some pretty important news that came out. We received the monthly payroll numbers, and the estimate was that payroll increases were going to be around 328,000. The numbers actually came in at 390,000 increase, which kept the unemployment rate at 3.6%. This continues to show that the labor market remains very strong with no signs of slowing down. And additionally, we reported average hourly earnings increase of 30 basis points, which puts the year-over-year increase at 5.2%. Now, if you want to read an excellent article on wage gains versus inflation gains this last year, financial advisor and CFP candidate Griffin Lusk wrote an excellent article titled Simple, Optimistic, and Uncontroversial, which can be found on the blog section of whitakerwealth.com. Now let's talk about the four things we learned. Number one, this week the Federal Reserve's Beige Book showed that Chair Powell is getting closer to his goals of cooling down the U.S. economy and bringing down inflation through tighter monetary policy. However, it will not be an easy task. This report, it provides a lens into business conditions that the Fed policymakers contacts share with them, and Fed Chair Powell has been a very vocal proponent of using this report, and we've seen it actually influence his views on monetary policy. Point number two, and something to really keep an eye on in the market, is the price of oil, as it has been a strong correlation to inflation and can foreshadow a possible recession. This week, WTI crude oil closed at $115 a barrel. This is the highest level since early February. And some good news is that WTI crude is only up 69% on the year. Now, I know only being up 69 is not something you think we should deem as good, but a good benchmark is to keep oil prices from doubling 100% within a year. Research shows that a jump in oil prices of 90% or more within a year is typically an indicator of a recession following. Point number three, every big tech name is lagging the broad market this year with an aggregate 24% weighting in the S&P 500. Their underperformance is having a measurable impact on the performance of the S&P 500. Big tech remains an important component of the S&P 500, and despite their recent decline, they still carry very high valuations. Until big tech stocks stabilize, we can't really expect to see a bottom forming for U.S. large cap stocks. Also, point number four, this week's poor performance can be viewed as a partial give back of these remarkable runs for these big tech names and the returns they had over the last 2 years. Analysts and investors throughout the world had changed permanently towards a big tech enabled online future. That lifted earnings and valuations, and now we're seeing that those were probably unsustainable. Stock prices always lead back to fundamentals, and all we're seeing now is a reset back to realistic profit expectations and earnings multiples, and none of these stocks represent any sort of broken companies. Now, we hope this information was helpful. A few just quick points on what we thought was moving the markets this week. As always, please reach out to your financial advisor at Whitaker-Myers Wealth Managers, who are always helpful, willing and helpful to bring these thoughts and processes right back to your individual situation. We thank you for trusting us, and we look forward to seeing you next week.